September officially marks the beginning of the traditional autumn selling season in the commercial property sector, and indeed a very busy autumn is in prospect. As we had anticipated, transactional activity in the office, retail and industrial sectors of the occupier markets paused for breath to some extent during July and August. This will change over the coming months as new mandates emerge. However, there's a shortage of stock in some of these sectors, particularly in prime locations. Activity in the investment, development land and hotel sectors continued at pace throughout the summer season, however, with the hotel sector having its busiest July and August on record. In the investment sector, as the new season kicks off, we expect to see another surge in activity. The new term will bring with it a wave of new assets to the market. There's also a large number of very significant transactions that will be concluding over the coming weeks. There are understandably some concerns about the potential impact of recent stock market volatility and indeed the uncertain macroeconomic and macro-financial picture. But as long as interest rates remain low, real estate remains an attractive proposition. In Ireland's case, supply shortages in some sectors of the market will prolong this momentum, particularly when economic growth and rental growth projections are taken into account. Prime yields in all sectors of the Irish investment market remain stable as the autumn selling season commences, with prime office yields today at 4.65%, prime industrial at 6%, and prime high street yields in Dublin at 3.5%. The latest returns from the MSCI survey of commercial property returns show that total returns of 6.4% were achieved in the second quarter, with annualised returns still over 30% year on year. There's particularly strong demand for large assets that are being brought to the market, as evidenced by some of the portfolios that have been for sale over the summer, including Project Jewel. We would anticipate that this appetite for large assets will become even more pronounced over the coming months as investors seek to deploy capital before year end. The sale of Project Trinity in Ballsbridge to Chartered Land and new entrant Adia was a very significant deal in the investment sector that occurred during the summer months because it represented the first deployment of Middle Eastern capital in the Irish market. We're anticipating a large number of assets to come to the market before now and year end. Indeed, there's visibility on up to 400 million of retail and indeed another 400 million of office properties, which are expected to be brought to the market over the course of the autumn. We also expect to see some new multi-family opportunities being released for sale, although we would expect investors will tread carefully until there's more clarity on proposals by government to introduce rent controls in the residential sector. In the office sector, there was a pause for breath during July and August, and we now expect that momentum to pick up again with a number of new requirements having been activated recently. Many of the requirements in the office sector at the moment are quite small in size, ranging between 5 and 15,000 square feet. We're increasingly seeing landlords placing more emphasis on covenant strength, and this may well pose a challenge for some of the more high growth companies, such as those in the technology space, who are actively looking for space. There are now 19 office schemes under construction in Dublin today. However, added together, they account for just over 1 year's annual average take-up, and indeed 45% of the stock that will be developed in these 19 schemes has already been pre-committed. So while there's quite a lot of development activity going on and quite a lot of planning applications being lodged, in reality rents will continue to rise until such time as this stock starts to hit the market in 2017. We estimate that prime office rents in Dublin today are €565 per square metre or €52 per square foot. There was a phenomenal recovery in the retail sector over the course of the summer months, as evidenced by the most recent stats from the CSO showing 9.9% year-on-year growth in July. There has been a dramatic recovery in consumer spending and retail sales, which is thankfully now beginning to filter down outside of the Dublin market into more provincial markets. We had a very strong summer, strengthened to some degree by bad weather, which boosted footfall numbers in many shopping centres and high streets around the country. Retail specialists, while there wasn't quite a lot of transactional activity going on in the property sector, were extremely busy over the summer months, working on preparing detailed due diligence for some of the very big retail portfolios that are on the market, including an interest in St Stephen's Green Shopping Centre in Dublin, Project Jewel and the national portfolio. The biggest challenge in this sector going forward is to find properties for the retailers that are looking for space, with full occupancy now being boasted in many schemes and high streets, particularly in urban locations. This will pose a problem to some degree for some of the temporary and pop-up retailers who traditionally start their search for Christmas premises at this stage in the year. Many of them will be forced to locate in secondary locations this year because of full occupancy on many of the major high streets where they were focused for the last couple of years. Just as in the office and retail sectors, there was also a slowdown in transactional activity in the industrial sector during July and August, and we expect that will change now that the autumn season has commenced. Having said that, there was quite a bit of activity in the data centre market during the summer, with Facebook having got planning permission for a new data centre on the M3, and Google having applied for planning permission for their second data centre outside Dublin. Demand for prime sites has increased significantly in the industrial sector over recent times, as evidenced by a number of recent transactions, but we think it will be 2016 before we see speculative development occurring in this sector. In the meantime, there will be upward pressure on rents. And now to the hotel sector. It had its busiest July and August on record, with more than 12 hotel sales concluding during the summer period, having already had a very busy first half where 39 sales totalling 575 million had been completed. In actual fact, with September-October busy trading period just commencing now, there's actually a scarcity of prime hotels to satisfy the volume of demand that's out there from hoteliers and investors alike. The summer also saw a raft of new reports being released and announcements being made that will have implications going forward for the development land sector of the market. It's now clear that the 276 million that transacted in the first half of the year will be significantly surpassed in the second half, following a number of large site sales concluding during the summer and some new sites that are expected to be brought to the market over the course of the autumn. To date, most of the land sales that are taking place are relatively small in size, and this is hampering efforts to increase residential supply, which is such a pressing issue for government at the moment. So as the autumn selling season kicks off, it looks like it's going to be a very, very busy couple of months in the wind down to the end of 2015.